All right, I think we're live.
Awesome.
Awesome. All right, well, welcome back, everyone. My name is Alex, and this is Joey. Oh, shit. My name is Alex, and this is Joey. We're both the co-founders of Mogul. Joey is out in California right now, so that's why we're doing this newfangled streaming device. But
New
with that,
format.
what?
New format.
New, yeah, with the headphone on, or with the like
The
massive
podcast headphones.
headphones on and stuff. Yeah, exactly. So we can jump right into it. Yeah, I mean, I'm looking at myself. I think I would be what my rowing coach in college would call an Italian club hopper with just the all black ensemble. And yeah, so
Hey, it
with
takes effort to look that good, okay?
that, yeah. All right. So with that, I mean, we can jump right into the questions that everyone's been sending in. Thank you again, everyone, for doing that. We're incredibly excited and backed by popular demand. We're going to jump right into these. So I think it makes the most sense if we just run through the properties. We can do it one by one. And Joey, I know you've been running a lot with this process and you've been picking some incredible properties out and throughout the country. And so maybe just want to start off with a brief overview as to why you chose the Logan, the one out in California.
100%. 100%. So as a reminder, yeah, this one's out in Yucaipa in the Inland Empire, about a 60-mile drive, about an hour drive east of LA. This one we actually ended up getting off market. So the thought process was here is that this one was originally listed around the $1 million mark, $1.1 million mark. We ended up going through an off-market process to get this one at $950,000 as our basis, which is incredibly accretive to value day one. Went out and originated new debt on this one. So that was one of our lending partners. And then we ended up originating a loan with 8.5% interest rate here, which was incredibly accretive to us at the time because the day one income yield on cost was targeting about 9.3%. So what does that mean, right? That spread against that interest rate means that we're able to pocket, again, all of that profit, right? That's going to be coming to us through cash flow because we're paying our lender the pre-negotiated rate that we've negotiated with them at the closing table. Any yield that we can achieve on the property day one and then grow that yield, usually around 3 to 4% per year from there on, is any spread on top of that interest rate is going to just be pure profit in our pockets, right? And that's the first aspect of the two pillars of value that are created through the real estate itself, the other one being the appreciation. So net income growth rate here, as I was saying, is about 3.2%. And, we want to see typically 3 to 4% per year. You want to see that kind of, NOI yield, right? That net operating income yield on that purchase price growing at least 3% per year. That way, that spread to that interest rate only becomes more accretive, even though that interest rate is staying in place. So great property here. This one's located out in wine country. Great views. I was actually out there this past Tuesday while I was going through town, and just absolutely beautiful, stunning. Reminded me of why we chose it in the first place. It's right near a bunch of incredible wedding venues and vineyards. Actually, it's funny because Ashton Kutcher and Mila Kunis got married right down the road from here, which is hilarious. But if you get a chance to check out the property on both the Airbnb listing coming soon and then also on the site itself, you'll just see how beautiful the pictures are, how incredible the updates look. And shout out to our team, the Merriman Contractors, for just doing an incredible job with the recent facelift that we did there. So yeah, great property there. Alex, anything you want to add or questions that we might have on that one?
Yeah, I mean, we can touch a little bit too on the leverage and why it's accretive in this scenario. So obviously you touched a little bit on how it's a high yielding asset. And so for that, I mean, margin expansion that you're discussing, which is just that rental yield over the interest rate. I mean, this one, because it's such a behemoth and because it really is going to be yielding a ridiculous amount, that is why it is an accretive leverage. And that's why it's in place. And we have a DSCR. I think it was about debt service coverage ratio, by the way, for everyone, is it's the amount that you're earning over the amount that you have to service the debt. And so that's your interest, your principal, whatever it might be. And so for this property, debt service, I think, was 1.31x, which means that it was about 31% higher, the rental income over that leverage interest rate, which again makes it a very accretive property, especially in the long run. And so that's the Logan. Again, if you're joining us just now, feel free to leave a question in the comment, and we can go off of some of those too. I think we just got one in here. It's are you open to a partnership with interior design firms? We're always open to partnerships, new partnerships with vendors, anyone that can drive incredible value for our rental properties. We're always open to. So feel free to email us at mogul@mogul.club. It's the email that sent out the AMA link for this exact AMA. And so feel free to leave a question. Check out the property, the Logan, at app.mogul.club. That again is a true 17% plus IRR, which is just absolutely ridiculous. And so we can dive into another property. Following the theme of succession character names, let's go with the Kendall. Walk me through the background, the Kendall, the Texas property that was chosen, which is absolutely incredible. If you just want to rip through that.
Yeah, so the Kendall, this one honestly has a special place in my heart. I think we got incredibly there was a mix of good skill and luck that came with the value accretion that happened day one here. Just incredibly valuable for everyone involved on the day one basis. Again, the second you invest, you're realizing that already baked in appreciation that would be experienced here, which we talked through on the last podcast, but I can also talk through here as well, or on the last episode of AMA, and can also talk through here as well. But this one, very, very similar to the one that we have in Houston, right? The Roman, which is already also live on the platform, we'll talk through next. So similar basis and similar business plan here. This one we got $432,500. Underwriting again on that 10-year hold. Loan to value here was 65%, which healthy on the new origination. One of the things that the lender likes to see is more of that like higher nominal check size for that higher LTV. So, we felt that in underwriting, kind of at the current interest rate that we were underwriting at, which was 8.125, the loan to value here made a lot of sense. And going back to what Alex was speaking on with the accretive leverage, right? As long as our yield is above that with a decent, healthy spread day one, you're going to rake in that spread above that interest rate, right? But given that's a pre-negotiated return to the lender, which is going to be pure cash flow to our investors and to ourselves. And that means that any appreciation that we're experiencing on top of that is purely at a 5-to-1, usually 4-to-1-ish ratio, all yours, right? Just again, because you're only putting in a usually small piece of that total capitalization pie, which is like, in this case, right, 35%, given that it's 65% mortgage. So you're putting in 35% just as a quick math walkthrough. That means if it's $1 million property, you're putting down $350,000. Say it appreciates, $100,000, which would be 10% on that, $1 million in the first year, which hint, this one's already very close to that percentage of appreciation day one. But say you get $100,000 of that appreciation on that $1 million, that means you're getting $100,000 first year of appreciation on your $350,000 invested. What is that, like 30, a little above 33%? They're south, so a little south of 33%. So that's just an incredible value creation day one. I mean, that's appreciation alone, right? That doesn't even take into account the yield on it. So this one I will say is going to be a little bit more of a mix of appreciation and yield, right? We were talking about what the business plan looks like on the Logan, which would be a little bit more of a yield play, right? That one also had incredible baked in appreciation because we got it off market, but in the go forward underwriting, it was like, 3 to 4% per year of kind of organic appreciation on top of that day one value add. And so this one's going to actually be a little bit more lucrative, I would say, in the appreciation forecast, because we were seeing closer to like 6 to 7% among the comp set in the kind of historicals and also go forward projections. And then this one, we're underwriting around 5% of annual appreciation. The great part is we've already achieved a massive portion of that up front, actually like basically 2 years worth up front. So the way that happened is we bought this one again, $432,500 at the settlement table. That means that we're marking that value day one, but then this one, when you mark it according to mark to market, right? When you're marking that value to where it really sits today, according to our API, shout out to Adam Data Solutions that we're currently using, incredible API, as Alex mentioned on the last episode, very conservative, very safe. They use tax level, municipal level data mixed with some appraisal level data and comp level data to essentially pull together what is usually around like a 3 to 5% actually conservative estimate on where properties typically appreciate on a year-to-year basis, according to the actual appraisals that are coming in. So this isn't according to your Zestimates or your Redfin estimates. This is according to true appraisal values. So with that said, definitely a huge appreciation play. This one came in at 489,000 recently, and like that's on top of the 432,000 that we bought it for. So let me just say it again. This mark to market recently on, according to our APIs, at around $489,000 on top of that $432,000. Insane. I mean, that's for 43,000 would be 10% of that 432. So that's basically almost like 10%, a little above 10%, day one, right? And so that's just absolutely lucrative. I mean, incredible find on the whole team's part. The sourcing here was great. We actually sourced this one in partnership with one of our infrastructure partners at Awning, who handles a lot of the property management, but also has an incredible investment sales arm. I would definitely check out their tool if you haven't already. If you're looking for more property management services on some of your vacation, short-term, single-family rentals. Let me pause there. I know that's a lot, but Alex,
Yeah,
anything you
I
want to add
think
there?
we have another question that came in. The investor return calculated from it is calculated from the purchase date. And so when we list the purchase date, that's the price that we're listing it out at. So we bought it for 432,000. We're selling it at 432,000. That's the return that you see in the return calculator. That's the amount that your dollar would appreciate if you invest today. So, for instance, I think for that one, it's about a 16 or 17% year one total return, including cash on cash yield, which is just, again, rental dividend being paid out to the end investor, and appreciation. That means it's on your dollar invested, it's 16 to 17%. And that's on the purchase price that we bought it for at the 432. This doesn't even account for the fact that it was marked to market at 490K. This is again on our conservative level basis that we had in that rental calculator. And so all of the returns that are calculated, that's based on your dollar invested. That's what happens with the dollar if it achieves the underwriting that we have set forward, which again, we leverage a very conservative underwriting even for that. And so we've already outperformed in a lot of these properties. Average property IRR, internal rate of return, which again is just a yearly basis, take into account time value of money, is about 17% across all properties, which is just absolutely phenomenal. So if you put in for the investor return calculator, put in 1,000 and it says 2,000, that's what your dollar does in terms of our underwriting if we achieve the base case. And so that's a little bit of background of that. I know we dove in a little bit to the numbers, but maybe we can dig into a little more the qualitative as well as the quantitative behind the Roman property. Again, if you're just joining us, feel free to leave a question in the comments below. Subscribe to make sure that you're kept up to date with the AMAs in the future. And also check out the properties that we're talking about at app.mogul.club, which is link is in the comment section below. So with that, I think we can dive right into the Roman. Joey, if you wanted to give an update on that one.
100%. And that was super helpful commentary. And the one thing I would add to spot on to everything Alex said is like that 17% is compounding every year, right? Based off of that internal rate of return. So not only are you getting that, $17 on that $100 or $170 on that $1,000, but next year you're going to be getting 17% on now that $1,000 plus that $117, right? So it's just incredibly lucrative when it comes to that compounding effect. Typical, buy, grow, sell model, private asset. Just can't stress enough how important that is in real estate. But yeah, like transitioning into the what I call personally the tall heath and what we obviously refer to as the Roman here. This is going to be one out near Lake Houston, and similar. Just wanted to touch on the qualitative portion of the Kendall as well. That one's right on Lake Hubbard in Dallas, like northeast of Dallas. Don't know if you've ever been there, but incredible lake, super fun. A lot of our current tenants and future tenants really seek that as a destination to kind of go out, take a boat out on the lake, rent a boat if they have one, great for them. They can bring it, take it out on the lake. It's super fun. Lots of amenities around the area. Obviously has incredible backyard with incredible pool and hot tub combo. This one as well, as you'll see in the pictures on the platform. And also if you want to go check out the Airbnb listing, if you're in the area, this one's again out near Houston, right on Lake Houston. So quite literally right next to the lake. If you ever get a chance to check out the listing, this one, just maybe a quick overview on the numbers, very similar business plan to what we saw at the Kendall. So this one's a $450,000 basis, targeting that kind of 16.5% annual net return, which is going to be that IRR that Alex walked you through. This one we had a little bit more creative leverage. It was a 75% loan to value at a 7.9% interest rate. Really, what happens there is it's just timing in the market. Sometimes lenders will be willing to underwrite, half a point below where interest rates are today. Sometimes it's a half point above. It really depends on how things fluctuate, and every lender has different requirements according to who they can sell these loans to on the servicing side, or if they're going to service it in house. There's just a lot of different things going on behind the scenes that we can jump into someday to kind of walk through. It's actually very, very interesting how that works. Capital markets are crazy. So just thinking about, a little bit more accretive leverage here, 75% LTV at a 7.9% interest rate, incredible day one income yield on cost at 9%. And we're going to see a similar NOI growth rate here around 3%, just like we did on the Kendall. But this one, 4-bedroom, 3-bath, can fit about 10 to 12 guests comfortably, built in 2008. And like I said, it's fully amenitized. I mean, if you look at a picture of the backyard, gorgeous. We just had it uplifted, full facelift on everything. Landscaping is great. Shout out to the landscaping team there. The pool and the hot tub are looking incredible. And Showplace just did an incredible job with the design here, I will say. So anything else that we need to add there, Alex?
No, I think that touches base on it, and then we can dive. I would say the Bowser one, the property that's sold out too, is, I mean, that's just obviously returning a ridiculous amount, new tenants in place. That'll be yielding a pretty sustainable and healthy margin, given it's a long-term rental. So we can just honestly pass over that one. But I would say check out the properties at app.mogul.club. These properties are absolutely incredible returning assets. These are the ones that we would have gone through on our investment committee at Goldman. And so with that, that's leveraging our backgrounds to bring those properties out to everyone. And so definitely check out the properties today because they're selling out fast. And so on the other question that popped up in the chat, it's, are you selling furnished property or staging? So we aren't so the fractional interest that we're selling on the platform today, these are all furnished properties except for the Bowser. The Bowser is actually, because it's a long-term rental, it comes unfurnished. And so as a result of that, the tenant actually brings their own furniture. And so with the short-term rentals, they do come furnished. So another question that we had, Bowser was financed at around 2.6, but the other properties are financed at around 8.5. How much does the higher financing rate affect the overall return, and can you provide pro formas? Yep, so happy to provide that. The pro formas that you can see are actually in that investment return calculator. You can see directly what the yield is, what the appreciation would be on your dollar invested to date. And so on the financing around the interest rates, so the 2.6 that we achieved on Bowser, that was because we were able to transfer over a 2.625% mortgage rate from the original owner into the fractional ownership on our platform to date. So that's an incredibly, obviously, accretive leverage rate, and that was in this past era of incredibly low rates. So long-term rental is a high-yielding asset when you have those rates in place. And so for the Bowser, that's why we were able to pass that along. Outside of that, the 8.5% interest rate, yes, again, I completely understand where you're coming from, but it just changes the operating model. And so for that 8.5% interest rate, this is actually a short-term rental property. And so the yield is actually much higher than 8.5%. And this goes back a little bit to that debt service coverage ratio that we had mentioned. And so debt service coverage ratio, again, for people just joining us now, means it's the amount that your rental income comes in divided by the interest rate and all the servicing that you need to do on the debt. So interest rate, principal, whatever it might be. And so with us, with that property with the 8.5% interest rate, that's a 1.31x debt service coverage ratio, which means that there's a 31% margin or just above the debt service. And so the 8.5%, we agree, it means that it has to yield more, which in this case it does because it is a short-term rental that's yielding a very sustainable one. So with that, it's that makes it an accretive leverage. And so if you have any more questions on that, happy to answer it. Is the property status of the properties current? I'm in the Logan, but the dividend date has come and gone, so it's not clear to me if this is rented and generating income. Joey, do you want to touch base a little bit on the Logan and the rental status there?
Yeah, absolutely. So again, was just out at that one earlier this week on Tuesday. It's looking amazing. So we're gonna have that listing live this month, which means that you're gonna receive your first distributions in April. So just as we started the first distributions on the Bowser, as you may have received very recently, super exciting stuff there. We're going to be doing the exact same thing for the Logan. So if you're invested in the Logan now, expect to see that first distribution in April, and you'll also see that mark to market start to happen as well as we continue to sell that one out.
Yep. So with that, I would say too, um, the Roman has been absolutely performing very well. I would say this month, and so first distributions will be this upcoming month for the Roman as well. That one, I believe, the occupancy is around 60% for this month alone in its first month of operations, which is absolutely incredible. We had tagged that one, I think, with a 9% cash on cash yield, and cash on cash yield literally just means the dollar that you get divided by the dollar that you invest. And so that's what we mean by that cash on cash yield. So if you have any more questions on any of these different properties, specific property questions, or specific questions about the platform, we're happy to answer them live. Just feel free to leave them in the comment section. So really appreciate those questions. I mean, going off the other kind of questions that we've received to date, I mean, we touched a little bit on interest rates. Do you want to touch a little bit more on it and your outlook to date?
Yeah, 100%. So, as Alex beautifully mentioned, one of the things that we're thinking through on these different business plans, and that thoughtful question that also came in, is with the model of that long term rental, right? As Alex mentioned, it's a lot more stable, being that you're signed a year long lease. You already know what's going to be coming in. The trade off is that it's obviously going to be a much lower yield, as Alex mentioned, right? So that revenue yield on your purchase price is going to be much lower, and then hence once you pay off your expenses, your net operating income yield after those expenses is going to be much lower relatively on your purchase price. However, that doesn't mean your return is necessarily going to be lower, because it depends on what that interest rate is, right? So for that Bowser, the fact that we were able to pass along that sub 3% interest rate, which is just crazy to even say, like, I just saying that right now is just mind blowing to me. We can achieve a much lower yield on that and still have just as an accretive of a return to our investors, right? Because that yield is so much lower. However, as Alex already mentioned, the short-term rentals like the Logan, like the Kendall, like the Roman, those are all going to have to be a little bit higher yielding, which is typically why people do vacation rentals, because they need that higher yield to pay off whatever sort of capital stack return is pre-negotiated, here being the mortgages with those higher rates. So where am I going with this? That segues into the new business plan for some of the properties we have coming online, which last episode we talked through. It's going to be that sale leaseback model, right? Essentially, in a nutshell, just quickly, we're buying properties mark to market from owners that are sitting on lots of equity built up in those properties. We can provide them feeless liquidity, which normally they'd have to pay 10% at the closing table for, or take out a home equity line of credit, paying a point to 2 points, 1 to 2% on the leverage that they're taking out just for originating the loan from the lender, and then also a pre-negotiated rate on top of that they have to pay back each year, usually above prime rate, which right now is about 8.5%, I think last time I looked. So that's going to be like 10% plus just on that home equity line of credit. Craziness. So when we do the sale leaseback model, we're providing them that feeless liquidity because we're the new buyer. We take out a portion or all of their equity. They then continue to live in the home, pay us back a premium on what their previous monthly payment was, which their monthly payment would have been that principal, interest on the loan, any maintenance expenses, obviously taxes and insurance that you have to continue to pay each year. And then they pay us back a small premium on top of that in return for massive amounts of free liquidity. They continue to experience value because they're living in the home. So effectively, that overage is now just a rent, which is relatively really small compared to what real rent would be in the area, definitively. And on top of that, they're now secured as a tenant because we're providing them massive amounts of liquidity, which secures their rental agreement, right? Obviously, we still run credit checks and background checks, but it becomes a lot safer at that moment. And then the rates, we usually can pass along that rate just like we did on the Bowsers, Alex mentioned, which is going to be very market agnostic, right? And we'll talk through the market in a second, but that rate coming in low because it was originated in a much more favorable environment means that even though we're only achieving a relatively smaller yield compared to like the vacation rental homes, it's still going to be very lucrative and accretive for our return because we're only paying back that pre-negotiated rate to that lender, which in the case of the transfers is going to be low, right? It's like, we're hovering around 3 to 5% on some of these things. So with that being said, where are interest rates going today? Alex, you want to drop your opinion? I mean, I have opinions. I'm hoping they come down. That's all I'll say. They're going to come down.
I mean, it's kind of interesting too. What a lot of people don't realize, and honestly, I was kind of shocked as well, is the mortgage rates don't necessarily, they're not, obviously they're correlated, but they're not directly correlated with what Powell says. And so Jay Powell, obviously in charge of the interest rates there, and Jay Powell, so to speak.
JP.
And yeah. And so just his comment alone can drop interest rates because the mortgage rates are due to the sentiment in the market. And so, with the outlook of interest rates coming down, when he came in and said that he's still cutting interest rates this year, which I think he did earlier this week or last week,
Yeah.
that means they already dropped a little bit just on that word alone. It doesn't have to be that that interest rate comes in and is just cut. It's actually being cut proactively. I think it was Greenspan back in the day when he dropped interest rates. It was just, I mean, he said something in an earnings call and then just boom, they dropped like crazy. Or yeah, it was just the wild swings are absolutely ludicrous, and they're not directly correlated with the actual drop happening itself. And so, if you're just joining us, obviously we've gotten some incredible questions, and feel free to leave them in the comment section, and we'll get to them as they come about. So I can touch on one of the next questions that we get always is, when you're thinking about your portfolio, how much should you allocate to real estate? And so, obviously, we can't give direct investment advice, just given you have to be a registered investment advisor for that. But what we can do is tell you what the modern school of thought is. And so, what the modern school of thought is, it's actually this Yale method. Sorry, Joey, I know you went to Harvard, but the Yale method is kind of this holy grail, so to speak, of portfolio allocation strategy. And so back in the day, there was this traditional portfolio method that was 60-40. So 60% stocks, 40% bonds. And for the longest time, that was the allocation strategy that won out. That was every endowment out there invested alongside that strategy, with the idea that it would be a risk adjusted return. So mitigating against risk, but still returning the same as a solid, just all equity portfolio. And so with that, in recent years, about 1985, there came about the Yale method. And so the CIO of Yale said, I think if you introduce real estate into your portfolio in a mix of 50% stocks instead of the original 60%, 30% bonds instead of the original 40%, and allocate 20% to real estate, it should outperform. And so what we saw between the years 1985 to 2021, they tracked the basket of a traditional method of 60-40 to this now 50-30-20, with the 20% going towards real estate. It outperformed in a massive amount, to the point where this Yale method has now become the de facto portfolio allocation strategy across all endowments. And they outpaced, I believe it was north of 30% on a yearly basis, which is absolutely incredible. So how much do you allocate to real estate? The Yale method accounts for 20%. And so if you have a $1 million portfolio you're looking to allocate, 200K in real estate is according to that Yale method. And so if you're just joining us, obviously leave a question in the comment section and we'll get to it as we go. But I guess, Joey, do you want to walk through, one of the questions we always get is, when I'm buying into something on Mogul, what exactly am I buying into?
Yeah, great question. So we're all about transparency here, right? So what these are, as Alex mentioned, these are investment clubs. So you're directly investing into this real estate. You're not buying into a fund that owns this real estate. You're not buying into, some investment management company that's then going to charge you 2.5% on your outstanding equity per year and scrape all the tax benefits off the top. This is true direct investment. So you are the owner, you are the governance, and what that means is you're making decisions directly on the outcomes. You are fully owning these LLC units of these real estate assets. What does that mean? It's direct investment. So essentially, we have these LLCs in place at a one-to-one basis. So one property company LLC with one real estate asset. The property company LLC is on the title of the real estate asset. Why do we do that? What's the point of that? One, it's limited liability, right? Like literally limited liability company. So we need to make sure that the LLC can be on that title. We need to make sure that you don't have to be the guarantor for that loan. We need to make sure that if literally the property gets sued because something happens on the property grounds, that you as the individual owners are not responsible for that, actually, which is great. But on top of that, you're running an autonomous company, right? These are autonomous LLC companies that you're investing in because you own direct equity pieces of that real estate. It's fractionalized ownership, right? The reason that we need these companies also is because you can't just split this title 100 different ways. Like I wish like it should be as easy as that. I mean, we'll fix title in the future, but one of the things that we do now is we have these property companies because you are directly investing in these LLC units that own these real estate. And so when you invest in that, it's yours. I mean, you truly own it. You have, again, say in the operations of it, according to how much ownership you have. So we have the voting system according to the operating agreement that you'll find on the platform once you buy into the properties and sign up. And then with that, really in the future, as we kind of previewed on the previous episode, we're going to be releasing probably late this year, if not early next year, a secondary exchange where you can also sell those units, right? Because again, if we had just strictly 2.0, as we like to refer to it, original titles, that would kind of make it a little more complicated as to what we're trying to achieve, having these assets truly live on the platform and you owning in and out of them, just like you would with any liquid asset, right? And so we're creating liquidity, we're creating direct ownership, we're passing along tax benefits, which Alex can walk you through and just absolute expert. And you're truly just getting that pro rata ownership and the benefits, the return from it all to you. We're not an investment management company. Again, we're not scraping, we're not charging asset management fees. This is true direct investment. We're merely your stewards. We're merely your facilitators, and we exist to make your lives easier to invest in these real estate assets without incurring crazy fees.
Yep. I mean, couldn't have said it better myself. So, headliner, you're buying shares in a property, you're buying the actual real estate, the cash flowing asset, and the appreciation that comes with it. So, that's what you own. I can touch a little bit on the tax benefits because it's funny. You never care about taxes or you hate talking about taxes until you're trying to find ways to pay less of them. And so the most interesting phone call I've ever had on my life was a Friday at 5 p.m. I called up TurboTax, and they had a pretty funny guy on the phone that just walked me through everything that was real estate and taxes and the benefits that come as a result of it. So everyone's wondering, how do the Bezos of the world not pay taxes, or how do any of these high net worth individuals not pay taxes? Obviously, there are tax mitigation strategies, but one of them is real estate. And so with real estate, the IRS wrote the tax code to incentivize home ownership. And so what that means is they baked in specific tax shields that protect the income that you get from the underlying real estate. And so what does that look like? What is the specific tax shield? It's called depreciation. And depreciation is, just boiling it down, is a ghost expense. And so this ghost expense means that it's not an expense that's directly coming out of your pocket, but it's used for tax purposes to protect against the rental income that you're receiving. And so your rental income comes in, you subtract out the operating expenses, you subtract out the interest. Now you're left with this income that still, it's not your taxable income. Then comes in depreciation. And depreciation is not being pulled from your bank account. So you're still receiving that yield up top, but that depreciation is shielding that yield against any taxes. And for the purposes of tax reporting, it actually means that you come out sometimes with a passive loss instead of a passive gain, even though that dollar is in your bank account. And so what does that look like when it compared against a REIT? So a REIT, if you were to receive rental income, they provide you 90% of all of their operations. They have to send it out to the end holder in the form of the dividends. And so that REIT, let's say it's yielding 10%, it gets cut down to 5% post taxes. So you put in $100, you get $10, but then Uncle Sam gets $5 of that. Now, with an actual real estate asset, like investing through our platform at app.mogul.club, it actually protects that yield. So if you get 10% yield, not only is that 10% 10% and it's in your bank account at 10%, but for the purposes of tax reporting, it actually looks like a passive loss that you put on your income statement against any passive income you get outside of it. So that's all boiled down to say real estate is a way that you pay less taxes on the income that you receive from the rental property. And it's because of this depreciation tax shield and the IRS incentives baked in that we see the lower taxes as a result. And so that's when you buy into real estate through our platform, we provide those tax benefits. It'll come in the form of a tax document end of year. So your rental income yield will be protected in the best way possible. So with that,
Goosebumps right there. Also, another benefit of why we have the investment clubs, right? They're pass-through entities. So these investment companies will again pass through those benefits directly to you. Well, completely well said.
yeah, I mean that's a deep dive on taxes, which is always fun.
You make it fun.
Yeah. Oh man. So with that, I'd love it if you could touch a little bit too. I mean, maybe if anyone has any questions, by the way, feel free to leave them in the comment section below or to the side. We'll get to them as they come up. We've already had some incredible questions already. And also check out the properties on app.mogul.club. But how do I receive returns on real estate? Joey, if you want to go high level, the 3 or 4 things that real estate generates and why people invest in it, why is it the biggest form of wealth generation across America? I'd love to hear it from you, obviously, because you are the Wunderkind, so to speak, of residential.
Well, the real challenge is keeping the explanation under an hour, but let's
Yeah.
let's aim for a couple of minutes here. So Alex already did a beautiful job mentioning the tax benefits, but let's talk about the actual property level cash flows themselves, right? What are we getting when we invest in this real estate? Compliance stuff aside, what are we actually investing in? What is our return comprised of? So two pillars, main pillars, right, of real estate value, and you can dive into these. You can argue that there's sub pillars, many different ways to pull levers to increase value across the board. But the two true generators of value, right, are the cash flow of the real estate itself, and then the appreciation that you're experiencing in the value, in the capitalization of the asset itself. And so what that means is it's operations and capital markets, right? That's kind of what I like to split up between the two. So operationally, every real estate asset that we have on platform is going to be yielding some sort of cash flow, right? And as we did at the beginning of this talk, and sort of just giving a quick recap, you're going to be usually taking out leverage against that. One, to increase your levered return, right? Because you want to be putting in less of the total capitalization of the real estate deal to receive more on that lesser piece. And so what does that mean operationally? Operationally, we're going to be taking this mortgage. It's going to have a pre-negotiated return, ideally lower than what the yield is going to be on the asset. That way it's accretive, as we like to use the word accretive. That really just means it's valuable. It's valuable to you. Any value that you're creating from the yield of the real estate is going to be directly put into your pocket once you pay that pre-negotiated return to the lender. Not only that, you're covering that pre-negotiated return. That way, that appreciation will be all yours at a multiple basis, because you, again, put down a smaller piece of that pie to get the whole piece of that appreciation on that whole piece of pie. And so what does that mean for operations? Operations, right? We have basically a couple different business plans for these residential properties. It's going to be long-term rentals, short-term rentals, and then we have that awesome sale leaseback structure that's coming online, which is going to be a form of a long-term rental. And so what does that mean, right? Short-term rentals, these vacation rentals are going to be these Airbnb Verbo properties managed by our incredible partners over at Awning. Shout out to them. They've been an incredible partner, done incredible things with us so far. And clearly, as we're seeing already with the Roman property, as Alex mentioned, 60% occupancy this month. And we just went live with that one last month. And so with that being said, that's going to be a huge piece of value, right? The operations, and especially in a levered investment, you're going to want to be pocketing that operational yield. You're also going to need those operations and that revenue yield to pay off all of your expenses and your debt services Alex talked through. And then the rest of that you're going to be pocketing as a return directly to you on top of the equity that you've invested. The other pillar, appreciation, right? This is the true bread and butter of where you're seeing a ton of value. Not to say that on the more yield heavy properties, like with the Logan, you're going to see a lot more of that value come from that yield. And then also any of that kind of appreciation value is going to be gravy on top, right? Because it's more of a yield play, but you're still going to be expecting that appreciation on top. When you think about properties like the Roman and the Kendall, that's where you're seeing a lot of the value come from the appreciation. What do I mean by that? So when you, again, as we give that example at the beginning of the talk, just a quick example, $1 million property, 5% appreciation, that's $50,000. Let's say you put in 20% of the total $1 million, that's $200,000. You're getting that $50,000 on that $200,000. That's 25%. day one, just, and that's from one year, sorry, of appreciation. Day one, if you can achieve, an appraisal value over where you bought it from, right? Like we did with those two properties. But what does that mean? So essentially, you're again getting that whole increased value on that pie, but you've only put in a sliver of that. You've only put in ideally, 20, 30% of the equity needed to purchase that entire 100% of that real estate. So massive, massive value driver there. We love appreciation. We love accretive leverage, and we love operational yield. And so two major pillars, you can dive within subsets of those pillars and what that means, and different levers you can pull, different capitalization structures you can do, different operational efficiencies that you can create to increase value there. But overall, in a nutshell, that's where I would kind of liken the two biggest pillars of value in real estate. Obviously, taxes is a whole different universe when it comes to creating value with real estate as well, but that's actually outside of the property level cash flows. And that's when you're looking at more like portfolio level returns, returns to investors on a larger scale when it comes to like, LP investors, bigger banks, who get slices of what pie. And then sometimes you'll have interacting economics between people within that capital stack, right? So with most of our properties, it's pretty cut and dry, whereby you have that equity stack that we're all investing in, and then you have the levered stack, right, which is the mortgage. But sometimes you can have preferred equity investors, which is going to be other investors sitting within that equity stack that have different economics with the rest of the investors in that stack. And then there's a whole nother set of essentially just profit share. And it's just an easy way to put it, but there's complex structures according to how that can be shared. And so there's also a bunch of different value drivers there, essentially usually as payment for a service that you're doing. And then on the leverage side, there's just we don't even have enough time in this whole segment to talk through what could happen there. But yeah, that's essentially the two biggest pillars of real estate value there.
Yeah, and I would say just three across the board: accretive leverage, yield, appreciation, tax benefits. Or sorry, four across the board.
Yeah.
Those four main pillars of real estate, and that's why you invest in real estate. And so that's kind of high level. And breaking it, and obviously appreciate Joey's in depth, but obviously for those of us with a short attention span, it's those four. It's those
I'm
four
included
across
in
the board.
that, by the way,
Yeah.
short attention span
Yeah.
here.
So next question, and feel free to leave us questions in the comment section below. Subscribe to the channel. That way you keep up to date with our AMA. But this question has been asked time and time again, and I can't get enough of answering it because everyone thinks investing in real estate means investing in a REIT. And so with that, how does a REIT work? And what is the difference between REIT and mogul investing? And so I can dive into this. And so with a REIT, real estate investment trust, it's defined by the SEC as the 75-75-90 rule. And what that means is 75% of your assets have to be in real estate. 75% of your operations and income have to be coming from real estate related activities. And 90% of your income has to be distributed in the form of dividends to the holder of the REIT stock. And so you as a user or as a holder of a REIT stock, you receive part of that 90%. Now, the rest of the 10%, what happens there? It's reinvested into capital. It's used to pay asset management fees, whatever it might be. That's what that kind of distribution model looks like. Now, how is a REIT different than investing in mogul? And so investing in a REIT, typically speaking, it might make sense to kind of get a hypothetical going. When you invest in a REIT, usually there's a spread of commercial real estate assets that they buy into. Some have residential maybe, but a lot of them are just spread out. And sometimes there's a mix of debt and equity investing in kind of a hybrid REIT structure. So what does that mean for you as the holder of the REIT? You don't really have a say over the assets that are in that REIT, but you're still holding the stock and still holding real estate. Now, as a REIT investor or someone that actually works in the REIT, they're targeting a specific yield requirement. They're targeting kind of bare bones vanilla returns of 5% yield, not as high leverage, maybe like 50% leverage LTV, because they're not incentivized to grow it out all that much bigger, because that 10% that they have to reinvest in other real estate assets, that doesn't drive that much growth year over year. And so they're incentivized to get a returning asset that's operating and just kind of going middle of the road. On top of that, when you receive that distribution, as mentioned earlier, in a REIT, it's taxed. And so it's pretty much halved. Any of that yield that you get, halved. And so, what does that mean investing in a REIT versus investing in mogul? Well, investing in mogul, you're buying into the property. You get to choose which property you see. It's a residential equity investment. And so you're not getting this mix of debt and equity that you would get with a REIT. You've got more control over your investment and what to decide. Now, the properties that we bring online, these are properties that we've diligenced thoroughly using the years of experience that we had at Goldman in their investment committee. These properties would have all passed through that with flying colors. So these properties, you invest, you can choose which property to invest in. You're receiving rental income from those properties. And as a result of that, we're actually passing along the tax benefits directly to you as the holder. So if you get a 10% cash on cash yield compared to a REIT, in a REIT, that would be 5%. With us, it's actually a true 10%, and you might get a passive loss on top of that. Now, that's just one of many ways. Obviously, on top of that, a private real estate investment, which this is pretty much exactly that, usually has a higher threshold of returns. And so with us, we said it on the last one, and we'll say it again, we have a hurdle rate of 12%. And a hurdle rate means that if it's not an IRR above 12%, then we don't consider it. We've turned down properties that return 11%, 10% because they're not as attractive as those 17 to 20% that we see on the platform today. And so those are the properties that we have on platform. It's the ones that we would invest in at our time at Goldman Sachs in their investment committee. And they're returning 17% plus on an average basis. They're yielding about 7 to 8 and 9% plus in most cases. And so that's kind of the difference between investing in a REIT and investing in real estate. Very different models. So that's a long-winded way of saying real estate investing is way better than REIT investing because you're actually getting the benefits of real estate. Now, on top of that, I guess we're down to the last, I would say, 1 to 2 questions here. If you do have more questions, feel free to shoot them in the chat. But I guess leaving off on a high note, Joey, want to touch on our top 3 competitive advantages for users?
Yeah, absolutely. So we always love to say people, platform, product, right? Big 3 pillars of what we do here. People speaks for itself. I mean, you heard firsthand from Alex how much thought goes into this, how much work goes into this. We're working behind the scenes every day to make your lives easier, to make it so you have this direct access 24/7 to the best real estate assets that we could possibly provide. And we have incredible team members behind the scenes making everything work, incredible partners, vendors, contractors that we're working with every single day to make this living, breathing machine continue to thrive. And so with that, platform. Alex can give you a sneak preview into some of the stuff we have in the pipeline, but I'll just say I see how much these guys obsess over it. Shout out to Eitan too, who's just constantly manning our technology stack on the head of that. And so he's just absolutely crushing with Alex every day. They're obsessive. They can't get enough of it. And they're just making it again. So your experience really at the end of the day is just the smoothest, easiest thing possible. So much going on behind the scenes. It's mind blowing, but it's so cool to see. It works. It's incredible. It's smooth. It's sleek. And I personally love it. And I use it as my savings account. Truly. I mean, any overage in my personal savings each month, I just throw right into Mogul, because why would I put it in a 1 to 3% annual yielding savings account when I could be achieving, that 12% plus, right, that we're aiming for. So incredible work on the platform. You'll see some cool updates coming soon. Alex can maybe touch on those before we sign off, but product, right? We've spent most of this talk talking about the product that we're out there sourcing for you. We have an incredible network of infrastructure partners, and I need to start using a word other than incredible. I'm realizing we have an awesome network of infrastructure partners, and they are working with us to source hundreds, if not thousands, of properties every single month. So that way we can funnel those down to the very few that meet all of our requirements that we are willing and proud to list on the platform. So far, properties have spoken for themselves. Go check them out again on app.mogul.club. Invest, give us some feedback, tear them apart. We're all here for the feedback, positive or negative. That's what we're here for, transparency. And we just want to grow your investments and grow the platform with you guys. And so with that, I don't know if there's anything, Alex, you want to add there, but incredible work across the board from everyone, and just so amped to be a part of this team.
Yeah, I mean, at the end of the day, this is your platform, right? The user. We built this obviously for ourselves to use and invest in real estate, but then we realized just how big of a gap that is out there in real estate investing. And so we open it up to everyone. And so you are a direct benefactor, but also the direct driver of our growth and the direct, I would say, direct feedback mechanism, so to speak. And so, with that, reach out to us over the chat, email us, whatever it might be. We can help to make this as beneficial a platform as possible for everyone. And so, right away, I'll use an example. We got on a phone call with a user last week. We've already made changes based on his kind of comments around, I'd love to understand more about the structure, the capital structure. So we updated a little bit of the layout in the layout page. We're constantly iterating, constantly making it better. But at the same time, the properties are still going to be those high returning, high yielding assets. That's never going away. It's really just how good of a platform it's going to be, which it's already benefited tremendously. So thank you again for joining, everyone. Really appreciate it. Send us questions. Obviously, we can answer it on next week's AMA, which we'll be doing 1 p.m. Eastern on Friday, March 15th. And so with that, have a great weekend, everyone. Thank you again for tuning in. Subscribe to our channel to stay up to date on AMA. Check out the properties that we talked about at app.mogul.club. Spread the word. Referral bonuses of $20 if you get a friend on board and they're investing, and first 50 for those of you who joined today. So really appreciate it, everyone. Take care. Joey, anything you want to say?
Nope. Thanks, everyone. I really appreciate it, and have a great weekend.
Have a great one. Take care, everyone. Bye.